Should you buy property right now? Should you buy property right now, or is it smarter to wait? If you've been asking yourself that question, stick around because I'm going to walk you through 4 real-world situations investors and buyers are facing this year and exactly how to think through each one. Before we dive in, if you're new here, hit that subscribe button, tap the like button on this video, and click the bell icon so you don't miss future videos on smart property decisions. Okay, let's get into it. Right now, rates are still elevated compared to a few years ago. The Federal Reserve has held its benchmark rate steady, and with inflation still running a bit hot, most experts don't expect a dramatic drop in rates anytime soon. At the same time, more homes are coming onto the market, which gives buyers a bit more choice and a little more room to negotiate than in recent years. So it's not a perfect market, but it's also not a frozen one. Whether buying makes sense for you really depends on your specific situation. That's why I want to walk you through 4 case studies, each representing a different type of buyer or investor, and how to work through the decision in each one. So without further ado, let's jump in with the first case study. Case study 1, the first-time buyer. The situation: imagine someone in their late 20s, steady job, decent savings, currently renting. They've been watching rates and feel like they missed the good window a few years back. They're torn between buying now at today's rates or waiting for a possible rate drop. The problem: waiting for the perfect rate is a guessing game. If they wait and rates drop, home prices could rise as more buyers jump back in, cancelling out the savings. If they wait and rates stay flat or rise, they've lost time building equity for nothing. How to solve it? The smarter approach is to separate the rate decision from the buying decision. If they find a home they can comfortably afford at today's payment, and they plan to stay at least 5 years, buying now lets them start building equity immediately. If rates drop later, they can always refinance. Buying the house locks in the asset, not the rate forever. The key is running the numbers on total monthly cost, including taxes and insurance, not just chasing a lower interest rate. Case study 2, the move-up buyer. The situation: a homeowner already owns a property with a mortgage rate well below today's rates, say under 4%. They want to move up to a bigger home, but are nervous about giving up that low rate. The problem: this is the classic rate lock-in effect. Selling means trading a low rate for a new mortgage at today's mid-6% rates, which can significantly increase their monthly payment even if the new home isn't dramatically more expensive. How to solve it? This buyer needs to run a full comparison: current home equity, new home price, new monthly payment at today's rate versus the value of staying put. Sometimes renovating the current home is more cost-effective than moving, but if the move is driven by real-life needs, more space, a growing family, a job relocation, then the higher payment may simply be the cost of that next chapter, and it's worth budgeting for accurately, rather than avoiding the decision altogether. A mortgage professional can model both scenarios side by side so the decision is based on real numbers, not just rate anxiety. By the way, if you want a structured, step-by-step way to manage rental income, tenants, and property finances once you do buy, whether it's your first place or your fifth, check out my Effective Property Management course. You can become a member by clicking the link in the description below to learn more. Case Study 3, the aspiring investor. The situation: someone with savings set aside wants to buy their first rental property for passive income. They keep hearing mixed messages. Some say real estate is the best hedge against inflation. Others say high rates have crushed rental math. The problem: at today's rates, the numbers on many rental properties are tighter than they were a few years ago. A property that would have cash flowed easily at 4% interest might barely break even at mid-6%. Without careful analysis, a new investor could end up subsidizing a property out of pocket every month. How to solve it? This case study comes down to running conservative numbers before buying, not after. Calculate the mortgage payment, property taxes, insurance, maintenance reserve, and vacancy allowance Then compare that total to realistic rental income for the area, not the best case scenario. If the property still cash flows, even at a slightly higher vacancy rate or a maintenance price, it's a solid buy. If it only works under perfect conditions, it's too risky at today's rates. Some investors are also finding better deals in markets with more inventory sitting on the market longer, since sellers there are more open to negotiating. Case study 4: the wait and see buyer. The situation: someone financially ready to buy, but who keeps holding off because they are convinced rates or prices will drop significantly if they just wait a little longer. The problem: this is an emotional trap as much as a financial one. Trying to perfectly time the housing market is extremely difficult, even for professionals, because rates react to inflation reports, employment data, and Federal Reserve meetings that are genuinely hard to predict in advance. How to solve it? Instead of trying to predict the market, this buyer should set clear personal criteria. An affordable monthly payment they've stress tested against their budget, a home that fits their needs for at least the next 5 years, and a rate they're comfortable locking in today. If those three boxes are checked, waiting for a better market often costs more in lost time and lost equity than it saves. The goal isn't to buy at the absolute lowest rate in history, it's to buy at a rate and price that work for their life today. So, to recap, whether you're a first time buyer moving up, becoming a landlord for the first time, or stuck in wait and see mode, the decision to buy right now isn't about guessing where rates go next. It's about running your own numbers and knowing your own timeline. If this video helped clarify things for you, do me a favor and hit like and subscribe so more people trying to make smart property decisions can find this channel. If you want to go deeper, I've put together a free ebook called Manage Properties Like a Pro and a free course to go along with it. Both are available to download at the link in the description below. And if you're ready for a full structured system to manage your properties like a professional, remember you can also become a member of my Effective Property Management course through the link in the description. Thanks for watching. I'll see you in the next video.